There's something unusual brewing beneath the surface of this market. Now, while the indexes appear calm, the SKEW index is spiking. So traders are paying up for that downside protection, and the IVOL premiums for the S&P 500 are climbing fast. Today, on the Stock Market Brief Show, we're going to be unpacking all of this and what it really means, because when smart money begins to hedge more aggressively, it's not always just noise, it could be a signal to us. Let's get into today's show. All right, ladies and gentlemen, welcome back to the show. So today we saw the markets rip a little bit higher here. The NASDAQ composite up 1.52%. Tech led a big rally there on the NASDAQ 100 up 1.42%. The S&P 500 finished just down under 1%. Out of the 11 sectors that make up the S&P 500, we had tech up there and communication services alongside financials. And financials took a beating, so we're seeing a little bit of a reflexive bounce here. Let's go ahead and hop into the SKEW chart here. Now, SKEW, in short, measures perceived risks of extreme moves, usually downside in the S&P 500. So when you have a SKEW that is rising or at extreme levels, there's increased demand for downside protection. Now, this is not a timing tool, and it doesn't mean that the markets are going to crash. That's, not necessarily the case that we're seeing here, but what I'm calling out that I find interesting that's been taking place is we do see demand for downside protection increasing in rapid formation. Actually, we haven't seen this reading of around 150 since about February of this year. So it's been a few months since we've seen this elevated SKEW. If we look over here, this is the S&P 500. I have the 5, 10, 20 timer on it. You can see we've crossed over here and we had the blue above the red above the green. It means that the 5, 10, and 20 EMAs are all stacked up. It's a nice trend. Now, as price is pushing up here, you start to see the current right here, IVOL premium take place is 36% or 1.36, but 22 days ago it was at 0.73. Then we were at 119. So what we're seeing here is the premium is increasing for the S&P 500, and what this could simply mean is as price behavior is rising into a potential resistance and the premium is rising as well, there is a lot of distrust in this rally, and it's being hedged or is marking as caution. Now, I want to add in some other elements here. You can see that we see the rising SKEW here, and then we have the put to call ratio over here. I apply the 10-day moving average, and sometimes when you get very extreme moves, like way over here is 1.0, it's just telling us sentiment is very bearish. And you can match this here looking down at the SKEW and say, oh, well, what's SKEW at? Well, SKEW's been dropping. And sometimes this can mark bottoms actually in the market when you get an extreme reading in the put to call ratio from a bearish perspective. And when SKEW, all of a sudden, all that downside protection starts to fizzle off. You can see the same thing over here. We saw that big spike up in the put to call ratio, a lower reading here, and that was marking almost the bottom of that 2022. Same over here. Going into the COVID pandemic, you saw a massive spike up in the put to call ratio, and then you also saw SKEW drop to a very, very low reading relative to what we're seeing here, and that marked just about the bottom of the COVID move. So what are we seeing now? We're seeing elevated SKEW taking place. Traders are reaching out for more downside protection or more hedging activities taking place. And we can really pair this with like, okay, what's taking place with the VIX, right? Is there something actually bigger going on? And we could also look over here back at this put to call ratio. What is this telling us? Well, what this looks like most similar to is what we actually saw recently before falling into this drop. We saw the put to call ratio fall into an extreme bullish sense, right? Getting into the red. So you want to be very careful. It's telling us that, hey, all these traders are really, really bullish. They're on one side of the boat. You might want to be careful here. The same thing happened back over here. And when it started pulling up, we saw the market kind of consolidate, pop up higher, and eventually kind of pull in as the put to call ratio went higher. And you can see same over here. We kind of pulled in, or we broke up higher. We pulled in. We're breaking up higher over here, and we're kind of rising as it stands right now. So the thing to be cautious of is obviously if this starts to continue to increase, could be bad for that S&P 500. Now, if we take a look at the VIX did come off. This is VIX futures. It came off today. So as we have rising SKEW, we do have a falling VIX. And if you take a look at the VVIX, it is still rather elevated, but it's not in like that area where you want to be significantly more cautious, but it still remains rather elevated. And what is the VVIX? For those that don't know, it's the volatility of volatility. So the fact that we're seeing this rising skew, we have the put to call ratio, not necessarily in any sort of extreme sentiment, but it does look very familiar from when we crossed over, and the market hasn't really digested too much. It's been on this kind of slow grind higher as various geopolitical stuff has been coming up, and then we also are getting more trade deal talks. There's a lot of uncertainty, and I think that that's what the market's preparing for, because if something were to occur, they want to be prepared once again for that. And I want to talk specifically about an intermarket asset that I don't think really people are too prepared for if it starts to move up. If we go over here, this is the put to call ratio, but just for the equities. So I showed you the CPC just a second ago over there, and that was the total put to call ratio. So if we extract that out and just look at the equity side of it, you can see that we're starting to creep up here too as well. And if you look back through, history, when you're at these kind of lower readings, what's the market doing, right? The market's pretty bullish, right? The market's moving up. And as soon as it starts creeping up, well, the market can go down, right? We're in these bullish areas, it starts to move up, the market goes down. And now, right, we're at these bullish areas. If it starts pulling up, right, it could potentially put pressure back into the markets there too as well. We still have the divergences that have been kind of playing out here in the bullish percent index for the NASDAQ composite, for the NYA, the NYSE bullish percent index over here. And then we're starting to see some weaker breath on the NASDAQ McClellan oscillator down here. We're seeing 2 consecutive readings of bearish internals as the market was pressing higher. Our summation index is still above the parabolic SAR, but it kind of clipped down just these couple other days. So we'll see if that changes. The NYMO, which is the NYSE McClellan oscillator, also 2 days of bearish breath. And it's just been kind of getting pretty weak as the market's been pressing higher into a prior area that we've seen supply at. If we take a look though at price action, we'll look at the SPY on the 15-minute time frame with the synthesized 5-day moving average in it. We saw a nice big run up today, and then it just consolidated throughout the day. We actually tagged right into an important zone. I'll follow through with that a little bit later. So as we see right here, we get a nice big gap up, follow through in the early session, and then we just kind of consolidated, and we're back above that rising 5-day moving average. So it doesn't look bad at all right now. It was worse down here, but yesterday the last video, we talked about the possibility for a bullish divergence to play out and to be aware of it coming back to the 5-day moving average. Well, it got above it, and well, it came right back down to it. So if we cross back beneath it, just be more cautious. But as it stands right now, at least the SPY is holding up, as well as the Qs. We had the bullish divergence. Boom, it popped up. It's consolidating here. Some might call this a flag. If it's a bull flag, we can wait to see if it wants to continue more to the upside, despite obviously seeing a little bit of these cracks and these very interesting things taking place that we've been kind of discussing here. IWM did not get back above the 5-day moving average, but we did see an update. It gapped up, came into and around it, and it's kind of pulled back. So the 5-day moving average has started to trend down, so just be aware of that. Same with the DIA, this is the Dow Jones Industrial Average. We came into where? The 5-day moving average. We kind of pulled back in. That was a big gap up. So we're kind of flagging here, but just be aware that we are below that 5-day moving average there. If we take a look at TLT came down about 1%, so pretty decent size move down in bonds. And you can see the 10-year yield rose to just under 4.6%. So we closed at it says 44.52, which just means that the 10-year yield is at 4.45 here. And this makes, kind of makes sense to me to see it bounce up from here, as we saw oil rise pretty rapidly in a very short order. And rise in oil can technically be a leading indicator of where yields may go. So oil today backed off a little bit. No surprise there. That was a parabolic shot up and now it pulled in. So we'll see how this consolidates and if it actually wants to head higher, which could indicate, hey, we might have more inflation problems or more geopolitical problems, and or a rising yield could put pressure on various growth stocks here too as well. So as oil went up, no surprise to see it pull down. I am interested because I didn't look into this, but potentially a repricing of margin requirements for if you're trading crude oil futures could be something to pay attention to there. Now, if we take a look at the dollar, this is the asset that I was mentioning that I think that nobody's really paying all too much. I mean, obviously there's a lot of people that pay attention to it, but I don't think people are prepared for a dollar to actually bounce. I think people are very bearish the dollar, and rightfully so, because it's been kind of just putting in lower highs. It's been coming down, kind of bumping on this trend line, which is rather steep. But I do want to call out that, we saw this pretty similar type move down over here, solid move down, and we saw this nice bullish divergence, and we led to a nice pop up in the dollar. Now, I'm not saying the same thing's going to happen here, but we do have a bullish divergence. We do have a trend line. You see the low and the lower low here, higher reading there. So if for whatever reason the dollar wants to pop up to 100, you really got to pay attention to what it's negatively correlated to. And in the prior video, we discussed that. And this is just one of those things that I'm seeing, traders reaching out for more protection. We're seeing the correlations change on the dollar. I think it's just it's just one of those times where for me personally, I can't speak for everybody. For me personally, like today, I took off some stuff, like I trimmed some positions on today's up day, and I have, once again, just a little bit bigger of a cash position because I've been kind of awarded the opportunity from my performance this year so far to sit back a little bit and be a little bit more patient here, as I have a strong feeling that in the very near future, we're going to see an expansion of price action. That doesn't necessarily mean bearish and doesn't necessarily mean bullish, but I feel like things have been getting very tight, consolidating, and seeing some sort of a bigger move seems likely. Now, this was shared to me from one of my ex-followers, the post by Jared over here. I don't think that this is his chart, but I'll just credit because that's who my Twitter follower, ex-follower sent it to me from him. And you can see the data source, I think, is Goldman Sachs. But I think this is just a percent vote. Like, are you bearish or are you bullish the dollar? That's what your view is. And basically, I mean, if you're bearish the dollar, like, welcome to consensus, right? This is extreme bearish. Look back through all the way to 2016. It's overly bearish. What he said here was, in case you're thinking about shorting the dollar, it's not exactly an original idea, which I would completely agree. Now, if you're bullish the dollar, that is a lot different of an opinion, and that's kind of why I'm building this case here. He sent me this as soon as I was literally putting this deck together and about to record, and I was like, oh, that goes perfect with what I'm trying to say here. So I think we got to pay close attention to that asset. If we hop into more market conditions, we can see the call wall right now at 6,100. We're in the middle of a contract roll, so just be aware that you're going to see days with more volume because of this roll, and don't get kind of confused by that. This is what happens. It's I think this is the largest contract roll that we're going through, this OPEX that we're going through. Again, right, we keep on breaking history with this stuff, but we'll see what this looks like coming out of that going into next week. But currently, we're at about 6,100, and if you look at that, 6,100 is right here at the upper quarterly expected move. We're not that far from it, so still the same story goes here, where we're seeing less reward to the upside versus the downside risks. So we really got to see things shift here quick to kind of get out of that idea, or out of that current framework that we're in here in the markets. Now, we're still in positive gamma. We came back into the flip line just on Friday's close, and we ended up holding it. So we had traders buy the dip, right? And then it's kind of sold off a little bit as it hit an important level intraday. It was a 1 DTE or 0 DTE call wall, and it acted as resistance throughout that trading day. In fact, you can see we put these daily eyeball ranges and daily EMs up in our Discord group, right? Earlier, I showed this Asher bot over here. This is my bot. I included this into the Discord where you can pull premiums and discounts up for any equity or ETF, and that's just an added enhancement for the many benefits in the Discord. If you want to take a look, there's all the benefits are listed here. Actually, not all of them, but the benefits that you pay for are listed here, and then I've added a lot more in as just time continues on. That's only $9 a month if you want to come in and check it out. If you do, by the way, if you do sign up through Patreon, just make sure you have to sync your Discord account to Patreon, and you'll give an automatic access. I don't post anything on Patreon itself. They just handle all the billing, all the people coming into the Discord community and out of the Discord community, and so forth. It just makes it easier for me. Unfortunately, I have to pay a fee for all of that, but it is what it is. So this is what happened intraday. We came back up to and around the quarterly expected move and that implied vol range, and we consolidated. We got back above last week's week-to-date last week's anchored volume weighted average price. That was the level we said, hey, just be cautious around here, but we blew through it, came right back down into it. So what happens if we cross underneath it? Just obviously be more cautious, because we'd be back under a neutral 5-day moving average, and we'd be back below to this week's week-to-date VWAP and last week's. Now, if we start breaking out of this kind of bull flag, where can we potentially go? Well, we can pay attention to the upper quarterly implied move. Now, going into tomorrow, our eyeball range brings us pretty far up there, actually, up to and around. This range actually kind of expanded based off of the implied vol, but the shorter term options implied move is still rather small, or within easy managing risk over here. 606.65 and then up to and around the upper implied weekly move, which is 609.85. Beneath us, we have a couple of gaps, right? We have this gap beneath us from today, this gap from the prior trading session earlier in June, and then we have our implied vol range. So if we were to break through these levels, I'd be seeing us potentially come down here, maybe press a little bit further to the gap fill and maybe bounce back up, doodle around, and we'll see if like there's any sort of market event that drives more volatility. But other than that too, just pay attention. We're at our quarterly expected move. We came up to it, we broke down from it, we came back up to it. Doesn't mean we can't break through it because we still actually haven't hit the S&P 500's quarterly expected move yet, and that's still up there at about 6016, 6015. So that's something to just kind of monitor as we go into the next trading session. As far as the Sailor to Shift tool goes, we did have a sell signal, but no official trigger yet. So we closed the week down here underneath the zero line on this specific week. So you might be saying, well, what's the trigger? Okay, well, this is the signal. And now the trigger would be is if price crosses down underneath this week's low. That would be the trigger. And what's price doing? Price is bouncing up a little bit higher right now. So we don't got one. So what happened? What would erase this sell trigger? Well, if we close back above this rate of change, and we never tag this right here would be a no trigger event, and we'd still be on our current buy signal from over here in our buy trigger. Now, what happens if we close right here where we're at underneath this rate of change and we're still in zero? Well, guess what? Then we would move technically our stop to the low of this trading week. And if we cross below the low of that, that would officiate our trigger. So right now we're on a sell signal, but there's no official trigger yet. And there might not be a trigger, but if we close our week, which there's still a lot of time left in this trading week, and we're still below this rate of change, and we haven't crossed through this, our stop would be the low of this next week, and that would be the official trigger. Now you can see this is all marked out. There's been times where we see no trigger events. I've been mopping them out for a very long time. You can see all the buy signals and sell signals here. It's caught the big run-ups and it's protected you from the big sell-offs. And the more recent one right here was from down here at around, I don't really know, 85-ish to 87-ish, and we're up here down up to around 110. So it's been a nice move. And then the last sell signal was over here, and boom, it took us from 100 down all the way to around 75,000 and protected us from that. So it's been a very useful tool, and I continue to track it and share it here on the channel. That's all I got for you on today's video. Hope it helps out.